Ladies and gentlemen, we find ourselves at a pivotal juncture in economic history. The signs are unmistakable, the warnings clear. The question is not whether challenges lie ahead, but whether we are prepared to face them with foresight and unity. We are now at a critical juncture where the trajectory of our fiscal policies, if left unaltered, will lead us toward a painful economic adjustment, one that could make a traditional recession seem manageable by comparison. What we're witnessing isn't just a cyclical downturn. It's the culmination of long-term structural imbalances that have been building for decades. The debt crisis we are heading into is systemic, deeply embedded in the architecture of our financial system, and the consequences will be more far-reaching than most people realize. When a government consistently spends more than it earns, the result is an ever-growing debt burden. Over the past several decades, we've seen debt rise exponentially, not because of war or extraordinary crisis, but as a feature of how we've come to manage our economy. Today, the United States debt has soared past $36 trillion, and the deficit continues to grow at a pace that far outstrips the economy's ability to keep up. This isn't sustainable. Eventually, the math catches up with you. You can't borrow indefinitely without consequence. Debt, by itself, isn't inherently bad. It can be productive if used wisely, financing infrastructure, education, innovation, or other investments that produce returns greater than the cost of borrowing. But we're not doing that. We're borrowing to fund consumption and entitlements, short-term needs that produce little or no economic return. That's akin to taking out a loan to pay for groceries while your income stays the same. Over time, the interest costs eat away at everything else. Eventually, lenders start questioning whether you're going to pay them back, and that's when things start to spiral. One of the clearest indicators of a looming crisis is what's happening in the Treasury market. Investors, both domestic and foreign, are increasingly reluctant to buy U.S. government bonds at the current pace of issuance. Think about that. The very instruments that once represented the safest store of value in the global economy are now being viewed with skepticism. Why? Because people understand that when you have too much debt, and you don't have the income to service it, your only options are default or devaluation. In our case, the devaluation comes in the form of printing more money, which leads to inflation, or trying to sell an increasing amount of bonds, which pushes up interest rates. This is already happening. The cost of servicing the national debt is growing rapidly. Interest payments are taking up a larger and larger portion of the federal budget, crowding out spending on things that are essential for growth. It's a vicious cycle. Higher interest rates lead to higher debt servicing costs, which leads to higher deficits, which then requires more borrowing, which again leads to even higher interest rates. And the more debt you accumulate, the less effective monetary policy becomes. In the past, central banks could lower interest rates to stimulate borrowing and spending. But when debt levels are already this high, and interest rates are rising, lowering them doesn't create the same stimulative effect. People are already over-leveraged. Businesses are already cautious. The marginal benefit of easing declines. It becomes like pushing on a string. This is also creating political tension, which adds to the economic volatility. When budgets become constrained, governments are forced to make difficult choices. Who gets funding and who doesn't, which programs get cut. These decisions become highly politicized. What starts as a fiscal issue quickly becomes a political and social one. The middle class feels squeezed, inequality rises, and the pressure cooker of populism begins to boil. There's a historical pattern here. This isn't the first time a leading empire has reached this stage of its debt cycle. The decline of reserve currencies, the debasement of money, the fraying of political institutions, all of these things have happened before. What's different this time is the global interconnectedness of markets and the speed at which information and panic can spread. A loss of confidence in U.S. fiscal policy doesn't just affect America. It reverberates across the entire global financial system. The solution isn't easy, but it's not complicated either. We need to bring our deficits under control. That means a combination of smarter spending, increased revenues, and a long-term commitment to fiscal sustainability. It means making politically unpopular decisions now to avoid economically catastrophic consequences later. And most importantly, it means recognizing the reality of where we are in the cycle, rather than pretending that we can continue business as usual. The clock is ticking. The longer we delay the adjustment, the more painful it becomes. But if we act with clarity, discipline, and a willingness to face the facts, we still have the ability to manage this transition in a way that avoids the worst-case scenario. The future is not yet written, but the direction we're heading in is clear, and it demands our full attention. The global monetary system is under extraordinary pressure, far greater than most people recognize or are willing to acknowledge. What's developing isn't just a financial adjustment. It's a fundamental disruption of the order that has governed global trade, capital flows, and economic power for the better part of a century. The balance that held the system together, anchored by trust, cooperation, and a shared set of rules, is breaking down. And when those foundational elements erode, the consequences are deep and lasting. At the heart of this disruption is the growing conflict between rising powers and established ones. The global monetary system functions best when the major economies are aligned, particularly around the role of the reserve currency, open capital markets, and the freedom of trade. But we're moving in the opposite direction. Countries are increasingly prioritizing self-interest over global integration. Economic nationalism is rising. Supply chains are being restructured not for efficiency, but for security. This creates friction, and that friction is being felt in the currency markets, in trade policy, and in the broader rules that have governed international finance since the end of World War II. One of the most significant developments is the weakening position of the U.S. dollar as the dominant reserve currency. For decades, global trade has been priced in dollars, and central banks have held large reserves of U.S. treasuries as a sign of stability. That stability was predicated on the belief that the U.S. had sound fiscal management, political cohesion, and a willingness to lead a rules-based international order. But that belief is being tested now in a way we haven't seen in our lifetimes. More countries are beginning to question whether it's in their best interest to continue holding large reserves in dollars. This isn't just about currency, it's about trust. When sanctions are used as a tool of foreign policy, freezing reserves, restricting access to SWIFT, weaponizing the financial system, it sends a message, and that message is, if you don't align with the interests of the issuer of the reserve currency, you may lose access. That undermines the perceived neutrality of the system, and as a result, some nations are exploring alternatives. We're seeing a gradual but meaningful shift toward regionalization. Countries like China, Russia, and others are working on bilateral trade agreements that circumvent the dollar. Digital currencies, central bank digital currencies, CBDCs, and blockchain based settlement systems are all part of an attempt to de-risk from over-reliance on the dollar-dominated system. This doesn't mean the dollar collapses overnight. That's not how these transitions work. But it does mean that the monopoly it has enjoyed for decades is no longer guaranteed. At the same time, the institutions that have held the system together, like the IMF, the World Bank, and the WTO, are losing relevance. Their frameworks were designed for a different world, one with fewer players, less geopolitical competition, and more ideological alignment. As that alignment fades, these institutions struggle to manage disputes or coordinate responses to crises. The rules are being rewritten in real time, and in many cases, they're being ignored altogether. This breakdown also manifests in trade. Global trade used to be governed by comparative advantage and mutual benefit. Now, it's driven by suspicion and strategic positioning. Tariffs, export controls, industrial policy, these are now the tools of choice. Trade is increasingly being used as a weapon, not just an economic tool. And when trade becomes political, the monetary system suffers. Capital doesn't flow as freely. Investment decisions are no longer purely economic. That distorts markets, suppresses innovation, and slows growth. All of this is happening while debt levels globally are at record highs and central banks are stretched thin. When the monetary system is under stress and the fiscal system is overburdened, the capacity to respond to shocks becomes limited. Coordination becomes harder. Trust erodes further. It's a feedback loop that, if not checked, leads to a breakdown in the system itself. We've seen this before. Monetary systems have never been permanent. The gold standard ended, Bretton Woods ended, reserve currencies have changed hands over centuries, from the Dutch guilder to the British pound, and now the dollar. These transitions are always marked by conflict, economic, political, and sometimes military. They rarely happen peacefully or smoothly. They happen when the old order can no longer sustain the weight of its own contradictions, and a new one rises to take its place. We're not there yet, but we are moving in that direction. The signs are clear. The institutions are weaker. The alliances are fractured. The incentives for cooperation are giving way to incentives for protectionism and division. If history is any guide, we should expect this period to be volatile, uncertain, and deeply consequential. Those who understand the dynamics at play and who are prepared for the shifts will navigate it best. Those who cling to the old assumptions will be caught off guard. The world is changing. The monetary order we've relied on for stability is evolving into something else, something more fragmented, more multipolar, and potentially more unstable. That's not a prediction. It's already in motion. And our challenge now is not to deny it, but to understand it, adapt to it, and shape what comes next. If you study history closely, really study it, not just the headlines, you start to see patterns, not precise repetitions, but rhymes. The dynamics that drive societies, economies, and global conflicts tend to unfold in cycles. Right now, we're in the middle of one of those major cycles, and the similarities to the 1930s are too significant to ignore. This isn't about being dramatic or pessimistic. It's about looking at the mechanics of how things work, recognizing where we are and what tends to come next. In the 1930s, the world was recovering from a major debt crisis. Leading into the Great Depression, the 1920s saw a credit boom. Asset prices rose, optimism surged, borrowing expanded. But like all debt cycles, it reached a point where debts became unmanageable. That's when the deleveraging began. Asset prices crashed, banks failed, and the economy went into freefall. Sound familiar? Today, we're coming off the back of a similar multi-decade credit expansion. Debt levels, government, corporate, and household are at or near all-time highs. The response to the 2008 financial crisis, and again to the pandemic in 2020, was to create more debt and print more money. That bought time, but it didn't fix the underlying problems. Just like in the 1930s, we are entering a phase of high debt, low growth, and increased social and political tensions. But it's not just the economic parallels. It's the political and geopolitical climate that echoes the past so loudly. In the 1930s, extreme ideologies gained traction as the middle class suffered. When people feel the system is unfair, when their real incomes stagnate and opportunity feels out of reach, they become more open to populist narratives. That polarization breaks down the political center. We're seeing the same thing now: increasing distrust in institutions, growing animosity between political factions, and rising nationalism across many parts of the world. Back then, economic stress also drove countries to turn inward. Trade protectionism became the norm. The U.S. passed the Smoot-Hawley Tariff Act in 1930, triggering a global trade war that deepened the Depression. Today, we're watching trade relationships fracture again. Tariffs, sanctions, and industrial policy are back in vogue, not for economic efficiency, but for national security and leverage. Just like before, countries are prioritizing self-sufficiency over global integration, which creates inefficiencies and fuels conflict. Perhaps most concerning are the signs of rising international tensions between major powers. In the 1930s, we saw the decline of British global dominance and the rise of Germany and Japan. That power shift, combined with economic weakness and nationalism, set the stage for global war. Now we are witnessing the relative decline of the U.S. and the rise of China. It's not just an economic competition. It's technological, ideological, and military. When a rising power challenges an established one, history shows us that conflict becomes increasingly likely, unless there is careful, deliberate management of the transition. That's rare. One of the key markers of the 1930s was a breakdown of international cooperation. Institutions meant to preserve peace and order lost their credibility and effectiveness. Today, multilateral frameworks like the United Nations, the World Trade Organization, and the Bretton Woods institutions are all under strain. They were built for a different era, one with a dominant superpower and shared post-war values. That world no longer exists, and without trust and cooperation, disorder follows. Currency dynamics also fit the historical mold. In the 1930s, competitive currency devaluations, what economists called beggar thy neighbor policies, were common. Countries raced to make their exports cheaper by weakening their currencies. Today, the methods are more sophisticated, but the impulse is the same. Central banks are stretched. Trust in fiat currencies is eroding. Gold, digital assets, and alternative stores of value are rising in interest, not because they are perfect, but because people sense instability. Now, to be clear, the future doesn't have to mirror the past exactly. We're not fated to repeat every part of the 1930s. But unless we understand the mechanics of what happened then, and how those same forces are in play today, we risk walking into the same kinds of disruptions unprepared. The biggest mistake policymakers make is assuming the present is too different from the past to draw useful lessons. That assumption leads to blind spots. What history teaches us is that if high debt, low growth, internal conflict, and external rivalry are allowed to escalate unchecked, they don't resolve themselves. They break things, sometimes suddenly, sometimes slowly, but they always break something. The key is to understand the forces at work, reduce the extremes, and rebuild cooperation. That's the hard part. It requires leadership, compromise, and a long-term view, qualities that are often in short supply during moments like these. We are not in exactly the same place as the 1930s, but we are in a place that rhymes with it, a phase where the old order is weakening and the new one has not yet formed. These are the most dangerous and transformative periods in history. How we manage this moment will determine whether we move toward renewal or descent. Confidence is the foundation of any financial system. It's not the numbers on the balance sheet, the legal frameworks, or even the military might that ultimately hold things together. It's trust. When people, institutions, and nations believe that the system will work, they operate within it. When that belief starts to fade, everything begins to shift, often in ways that are slow at first, then suddenly accelerate. What we're seeing right now is a gradual but growing erosion of confidence in U.S. Treasuries, once considered the safest and most reliable asset in the global financial architecture. That erosion carries profound implications. For the better part of the last century, U.S. Treasuries have served as the bedrock of the global financial system. Investors around the world, governments, central banks, corporations, and individuals bought treasuries not just for their yield, but for their perceived safety and liquidity. They were treated as risk-free assets because the belief was that the United States would always pay its debts, that its economy was fundamentally sound, and that the dollar would hold its value over time. That belief is now being questioned more seriously than at any point in recent memory. The core issue lies in the supply and imbalance. The U.S. government is issuing more debt than ever before, and the pace is accelerating. At the same time, traditional buyers, particularly foreign central banks, are pulling back. Countries like China and Japan, which have historically been among the largest holders of U.S. Treasuries, are reducing their exposure. This isn't speculation, it's visible in the data. The reason isn't just political, it's economic, with rising geopolitical tensions, trade frictions, and the weaponization of the dollar through sanctions. Holding large amounts of dollar-denominated debt no longer feels as safe as it once did. When confidence goes, capital follows. Domestically, the problem is equally troubling. The Federal Reserve has shifted from being a net buyer of treasuries during periods of quantitative easing to a passive or even net seller in a world of quantitative tightening. That leaves a huge gap in demand, just as the supply of new debt is exploding. To fill that gap, yields must rise, and with them, interest costs on the debt itself. It's a self-reinforcing cycle. More debt requires higher yields to attract buyers, which increases interest expenses, which leads to larger deficits, which requires more debt issuance. This dynamic is already beginning to crowd out other spending, as interest payments take up a growing share of the federal budget. The room to invest in infrastructure, education, defense, or healthcare shrinks. That puts pressure on the political system, which is already deeply polarized and struggling to reach consensus on basic fiscal priorities. Markets see this, investors see this, and what they're starting to price in is not default in the traditional sense, but a decline in real value, in purchasing power, and in the relative attractiveness of holding U.S. debt. One of the things that makes this erosion so dangerous is that it feeds on itself. When confidence begins to slip, buyers demand higher premiums, which weakens the balance sheet further, which erodes confidence even more. Eventually, you reach a point where the cost of stabilizing the system becomes extremely high. The last line of defense is the central bank. But when the central bank is already stretched and when its actions, like printing money to buy bonds, trigger inflationary fears, its ability to restore confidence is constrained. This brings us to inflation. For a long time, U.S. Treasuries offered not just safety, but also stability in purchasing power. But in a world where inflation is persistently above target, that assumption no longer holds. Real yields turn negative, and treasuries become less attractive relative to hard assets, equities, or even foreign sovereign bonds. This is especially true in a multipolar world, where capital has more alternatives. The competition for trust is increasing, and the U.S. is no longer the only game in town. Investors are rational. When they see fiscal trajectories that are unsustainable, debt growing faster than GDP, political systems unable to address the imbalance, and monetary authorities forced into reactive rather than proactive behavior, they adjust. They hedge, they diversify, and as more capital shifts away from treasuries, the signal is clear. The confidence that once underpinned the market is no longer unconditional. This isn't a crisis today in the way most people recognize a crisis. There's no dramatic collapse, no sudden event. It's more like a slow leak, one that becomes harder to ignore as it accelerates. But if left unchecked, these types of gradual shifts become tipping points. The U.S. can still address this: fiscal discipline, political stability, credible monetary policy. These can restore confidence, but that window doesn't stay open forever. Trust, once lost, is hard to regain. What's at stake isn't just interest rates or debt levels. It's the role of the United States in the global financial order. Treasuries are more than just bonds. They are a reflection of faith in a system. And that faith is no longer what it used to be. The question now is, will the necessary changes be made before that erosion turns into a fracture? History suggests that the answer depends on whether leaders can act with clarity before the consequences force their hand. Strategic reform isn't optional at this point, it's necessary. The systems we've relied on, from our economic structures to our political processes, are showing signs of deep dysfunction. We're facing challenges on multiple fronts: unsustainable debt, growing wealth gaps, declining productivity growth, and increasing geopolitical tensions. These aren't isolated problems. They're symptoms of a system that's reaching the limits of what it can handle without major structural changes. And history teaches us that when the pressure builds to this level, the choices become clear: either reform or suffer a painful reset. To start, the most urgent need is to deal with the debt problem in a sustainable and smart way. That doesn't just mean cutting spending or raising taxes. It means rethinking how capital is allocated, how incentives are structured, and how we measure value. Right now, debt is growing faster than income, and that's a classic sign of an unhealthy system. In the long run, income has to grow faster than debt for the system to be stable. That means we need policies that drive productivity, not just consumption. Investment in infrastructure, technology, and education, all the things that create long-term productivity gains, must take precedence over politically popular but economically unproductive spending. At the same time, we need to rebuild the middle class. Wealth and income gaps have become dangerously wide, and they're contributing to rising internal conflict. When people feel like the system is rigged, that opportunity is no longer accessible, and that their hard work doesn't lead to a better life, they stop supporting the system. That's what we're seeing now. The key is to create a more equitable form of capitalism, one that rewards innovation and effort, but also ensures that the benefits are more widely shared. That doesn't mean turning to socialism or abandoning markets. It means strengthening the bottom and middle while maintaining incentives for the top to invest and create. Tax policy has to play a smarter role here, not just higher taxes, but more efficient and strategic ones. We should be incentivizing long-term investments, not short-term speculation. We should be making it easier for people to start businesses, not harder. And we need a system that taxes wealth and income in a way that's fair, transparent, and doesn't create distortions that push capital offshore or discourage growth. The goal is to fund essential government functions while encouraging the kind of behavior that builds a healthy, dynamic economy. Monetary policy also needs reform. For too long, we've relied on central banks to be the sole firefighters in every crisis. That's not sustainable. Interest rates are already low, balance sheets are stretched, and the diminishing returns of easy money are clear. We need a better balance between fiscal and monetary policy. That means aligning spending with long-term priorities, being honest about trade-offs, and coordinating across institutions in a way that puts the long-term health of the system above short-term political gain. None of this can happen without political reform. The level of dysfunction in policymaking today is one of the greatest threats to national and economic stability. The incentives in the political system reward division, not solutions. We need leadership that can think in terms of decades, not election cycles. That may sound idealistic, but it's what history tells us is required during periods of structural stress. If the system doesn't self-correct from within, the correction will come from without, and it will be much more painful. Strategic reform also means thinking globally. The U.S. is no longer operating in a vacuum. We are in a multipolar world where global cooperation is harder to achieve but more essential than ever. Trade, technology, climate policy, even currency dynamics. All of these require coordination with other powers, even those we see as rivals. That means engaging with the world in a more strategic, less reactive way. It means recognizing that power, like capital, flows to where it's treated best. If we want to preserve influence, we need to preserve credibility. The window for reform is not infinite. The longer these imbalances persist, the fewer good options remain. Crisis is a poor substitute for strategy. We can either make hard choices now through thoughtful, inclusive, and forward-looking policy, or we can wait until markets, voters, or external events make those choices for us. That's what history shows. It's not a question of if change will come. It's a question of whether we guide it or are forced into it. What's required now is clear thinking, strategic planning, and above all, courage. Courage to break away from old assumptions, courage to confront entrenched interests, and courage to prioritize the long-term health of the system over the comfort of the status quo. That's how we navigate through the storm. That's how we create a future that's not defined by crisis, but by renewal.